Hello everyone. Today we're going to be talking about DeFi, which is decentralized finance in crypto terms, and we're specifically going to be talking about how you can make money out of decentralized finance. We've covered a bit of decentralized finance, but I'll explain the basics about decentralized finance and how you can make money about it. Now, so first question is why DeFi? So there's a teaser that I prepared for the content, which is like, people ask me about Bitcoin mining, how you can do crypto mining. Now, to do Bitcoin mining and crypto mining, you need technical knowledge, you need to buy hardware, computers, or you need to know something about mining in general or computers in general. But with decentralized finance, you don't need to have a computer knowledge or a technical knowledge. You can probably make more return of investment using decentralized finance, using liquidity mining in decentralized finance, than using the conventional crypto mining or the Bitcoin mining. That's why we need to look at DeFi, and that's what we'll be looking at in detail today. So you would have noticed that this video is actually a lengthy video. Now the reason why the videos are a bit lengthy, especially like in I think episode 1, episode 3 and episode 15, they were some of my lengthy videos. The reason why these are lengthy videos is because I'm trying to make my content for people who have no idea what crypto is, or who have no background in crypto market or crypto industry, and they are like beginners or learners, like how I was beginning of last year. And whatever I've learned, I wanted to share it with everyone. That's why I go into the bit of detail, assuming that people don't know anything about the subject, and try and build it for people who can understand it easily. And I give context, and I give examples which are easy to understand for people. And when you try and do that, when you try and explain it in such an easy language, when you're trying to simplify the concept, you need to simplify it in a language that they're able to understand, which makes the video lengthy. And it's not that I get more money because I make lengthy videos. YouTube is not my profession. I make YouTube videos because I wanted to share the content that I have learned. YouTube is not my profession, and I spend a lot of time making these videos, so it's easier for me if I make smaller videos, but that serves no purpose. And some of this content, especially the DeFi content that I'm showing today, had taken like almost several weeks for me to prepare, to oversimplify the content, to prepare the demo for the content and everything that had to go into the preparation of the content itself, right? That had taken several days. In fact, almost like 5-6 weeks I've been putting this content together. And I think after episode 15, this was one of my most difficult videos in terms of content preparation. That's why the video is long. So if you are really interested in making money, if you're really interested in understanding it, your time is more important than your money, and you will probably watch the video fully, and then you'll be able to understand and appreciate it better and use it properly. So let's get into the video. So let's start with the disclaimer and warning. I'm not a financial advisor. I'm not an investment expert. So these videos are not an investment advice. They are for learning purposes. I'm sharing my personal experiences, and these are for learning purposes only. Now, one bit of warning is that never send your money to professional brokers or investment. Most of the advisors, most of the brokers who want to take your money are frauds. I will not approach anyone in an email or a comment. If somebody is using my name also, don't ever send your money or crypto to anyone. Your money, you invest it. So today's agenda, we'll be talking about what is decentralized finance, what is all the hype about. So we'll do a DeFi intro, main advantages of DeFi. We'll look at the terminologies and introduction. And then we will also be looking at liquidity pool. That's the main concept that we need to understand. And liquidity mining finally. Now the trailer for the content, right? So people who understand crypto today, right? People who don't understand crypto versus people who understand crypto. It's like 20-25 years back, people were using Kodak film rolls in cameras without knowing what digital cameras were. People who were using digital cameras at that time were saving so much money on buying film rolls and not requiring to go and repeatedly buy those film rolls. That's what crypto industry is looking like. But with DeFi, people even who understand blockchain and cryptocurrencies and people who don't use DeFi, it's like people still using digital cameras but not understanding what a smartphone is or what a smartphone camera is. Now everybody is using smartphone cameras today, but 10 years back or 20 years back, if you told somebody that people will not use a camera, a normal camera, Kodak film camera, or 10 years back if you told someone that digital cameras will also go out of fashion, people wouldn't have believed it. That's the kind of innovation that we are talking about with regard to the decentralized finance. So that just gives you a flavor of the technological advancements that are happening in blockchain, and that too within a span of 10 years. The amount of progress, technical progress in blockchain has been staggering, and we'll look at what the technical progress actually has meant for common people like us. So what is DeFi? DeFi stands for decentralized finance, and it taps the true power of blockchain and crypto. There are so many usages of blockchain and cryptocurrencies, but probably nothing comes close. NFTs come close, but we'll cover it in a different topic. Decentralized finance probably taps the true power of blockchain and cryptocurrency like nothing else, literally. The ability to have a true financial ecosystem that is not controlled by an organization, by one person, and controlled by common people without any middlemen, right? That's the goal of DeFi. And how does it achieve it? What does it mean? So essentially, DeFi lending through a concept called smart contract is a peer-to-peer loan. And these are the three common products, right? DeFi lending, and then there is a DEX, which is Decentralized Exchange, buying and selling. And then the final concept that we're going to look at today is liquidity pool and liquidity mining, which is in a way related to Decentralized Exchange, but that's the main product that we're going to look at. So these are some of the use cases of DeFi that we'll look at today, which will help you understand what DeFi is all about and how you can, and finally when we talk about liquidity mining, you will be able to understand how this finally translates into an earning opportunity or an earning potential for common people, for anybody, like, even if you have 100 rupees, how you can invest it and get a portion of the investment or revenue from it. So in its simplest form, right, DeFi lending is like a peer-to-peer loan service. People always exchange collateral and loan between themselves. There's so many pawn shops where you can go and get money from somebody. But imagine you go to a bank and then you pay interest to the bank, right? That's like a centralized exchange. DeFi is like going to one person or somebody that you know, or an individual, and you're paying it back with an interest to that, a lower interest to that person. Let's say bank is saying 10%, and another person that a friend probably is giving like 2% or something like that, 3%. Then you basically go and get the money from him and paying back. But then fundamentally there is a need to trust that person. So what if we don't have to trust that person, right? That's what DeFi is doing. Let's look at another example. In centralized finance today, in the traditional financial system, we all deposit our money into banks and savings account. And what these banks do essentially is that they take our money, and our money is then loaned back to people again at a higher interest rate, sometimes even up to 15% interest rate on home loans and 40% API on credit card loans. The credit cards that we don't repay, if you don't realize, you actually end up paying like 40% API on those credit card loans. And home loans, even though it says 15%, 20% or 10% sometimes, right? Everybody know that if you take like 10 lakhs loan over a 20-year period, you're ending up paying nearly double or triple that amount, 20 to 30 lakhs as a loan. So home loans, sometimes the APY is also miscalculated. So the amount of money that they make by loaning our money to others is staggering. And sometimes we might even take a loan from the same bank in which we have our bank balance, and they might be double charging us by asking us to pay interest on the loan that we take, and also will be asked to minimum account balance and everything. We might be getting charged on the fees on that end as well. So the banks are basically making money out of our money, and they are probably giving very, very less money back to us. In fact, in UK we get like less than 1% bank interest if we keep our money, even if I keep like 100,000 pounds in the bank. So another example is the common jewel shop loan, right, or the pawn shop loan, where if you have a jewel in India, for example, you can go and put it in a pawn shop, and you can get money out of that guy. But that guy will generally charge you a very, very high interest rate. I mean, we all know how the Indian pawn shops work. The UK pawn shops, the worldwide pawn shops work pretty much the same way, right? Jewel loans or whatever collateral that you go and give. There's like, there is a possibility that the guy might be charge you like 50% APY. So if you get like 5,000 rupees loan from that guy, you might have to return like 1,500 rupees in total, and 500 rupees is the profit directly going to that pawn shop guy. So it is again centralized, even though we say that it's not the bank involved. It is still centralized because this one guy is making all the profit. At the same time, 10 people in the same village where this pawn shop is operating might all have 100 rupees each, but they don't actually give it to this guy. But what if this guy can take the loan from these 10 people, all of them giving 100 rupees to this guy, and he pays like 20% APY interest, which means that he's only paying back 200 rupees and he's saving 300 rupees, and everybody will get a share of that 200 rupees. If we equally divide it, it's 20 rupees profit for them. So they had 100 rupees, now they have 20 rupees profit by loaning it out and safely getting the money back from this person. And the guy is also saved 300 rupees, and you've eliminated the guy who was making so much profit. But how do you do this? Because how do you connect these 10 people with this one person, right? And how do you make sure that the jewel is safely kept? How is it returned? Who monitors it? Who makes sure that the money is distributed to these 10 people? Who collects the money from this? There are so many things that need to be done. So what if there was a coordinator or an organizer, and that the organizer says that he'll keep a small percentage of the profit? So if there is 200 rupees profit and everybody is getting 20 rupees, let's say he takes 2 rupees from each person. So for them, it's like, still a win-win scenario, because they're getting like 18 rupees back. Now, trust is the main issue, right? How can we trust a human for this? Because the guy can take away the money and run away, he can do all sorts of things with it. But what if instead of a person, instead of a human being, what if that's a robo, or if it's a computer that is doing it? Like, we've seen robots in movies and everything, right? Like not like an Ultron robo, but like a good robo. Let's say that like a Chitty robo, for example. What if there's a robo that never lies, never cheats, it can never be controlled, never be hacked, and it's always loyal and it's always truthful, right? So if that robot sits there and then it collects the money, and then it takes the jewels, keeps it safely, safeguards it, pays it back, and it says that I want even lesser profit, or lesser profit share. I'll keep only 1 rupees for my charging of my electricity or whatever. And then it says that, I will give everybody 19 rupees back. So it's still working. So replace that robo with a computer program, and that program is called as the smart contract. So the smart contracts are really small computer programs that can run on the blockchain itself. And not all blockchains support it. For example, Bitcoin doesn't support a smart contract. There are certain blockchains like Ethereum where they have a virtual machine, Ethereum virtual machine, that supports these smart contracts. So you can only deploy these smart contracts on certain blockchains. And what happens is, in essence, that does the job of the robo. It basically collates money from people. And you can put money, you can put your crypto as a collateral. Like you can put your, whatever crypto that you have, like gold, you can put it as a collateral and you can take money from it. And the smart contract automatically gets created and it collects money from the lenders. It gives them the interest back. And when you repay the money, when you repay the loan, it gives you back your collateral. So everything happens, invisible to the naked eye. And that's exactly what we were talking about, what if we could do that? And that's what has been done in decentralized finance in the smart contract lending process. And you will see a lot of DeFi lending providers offering smart contracts and offering percentage interest on the money that you deposit. Even if you have 10 pounds worth of crypto, you can actually use it to lend it into the DeFi lending platform. And that's when you can use your money to earn like 20-30% out of the DeFi lending, because somebody is taking a loan off that DeFi lending platform and they are sharing most of the interest with you, because that's the decentralized finance concept. So in the example that we spoke about, 1,000 people can actually converge together, and even if they put 1 rupee into this smart contract, 1 rupee into this lending process, there is a loan of 20,000 rupees that can be given to one person, and everybody will get a share for that 1 rupee that they are depositing. So earlier, even though there were investment opportunities where people with a little bit large amount of money can contribute to the ecosystem, people like small investors were never allowed to take a pie out of those lending platforms or any investment platforms. If you have only 10 rupees, 50 rupees, 1 rupee, you were never allowed to be part of these kind of ecosystems before. Now with smart contracts, even if you have a very, very small amount of money, you can actually put it and you can trust it and you can get your interest back. And it is a safe ecosystem that they are creating. Pretty much the whole concept of blockchain we'll be talking about from episode 00 to episode 01, that how the blockchain, unlike the conventional database, cannot be hacked, cannot be modified, and why the blockchain technology for data storage or for the crypto industry is essentially a leap in terms of the technical computing that we've had, and the smart contract builds on top of it to say that, it gives you the security that you can get your interest back and a passive income out of your money in a safe way. I mean, even if you put it in a bank, banks are also often hacked, and that's why the smart contracts are often even better security and even better collateral power, that they can combine people together from one corner of the earth to another corner of the earth pretty much easily. Now let's look at decentralized exchanges, or what is called as DEX in common or in short. In its simplest form, like we talked about the DeFi lending, right? In its simplest form, DeFi trading on the DEX is practically a barter system. People used to exchange products and services between themselves. Like if I made tomatoes and you made onions, we can exchange tomatoes and onions. And if you're a barber, for example, I'll give you 1 kg of rice and you do my whatever services that you render, right? So you can get services or products, and they used to barter exchange between themselves. And that's when we evolved into money, and we've gone into crypto and all that. So we're kind of going back to the same concept, that people are able to exchange products and services between themselves. And imagine going to a supermarket and you're buying vegetables and fruits that are available in a supermarket. That's a centralized exchange. DeFi exchange or DEX is basically, decentralized exchange is basically, you can go into a farmer's market and you are basically able to exchange fruits and vegetables without any middlemen in operation. We'll actually take on one example of this, and then we will use it to demonstrate how the DeFi process works. And you don't need to know each other. And fundamentally, you don't need any permission. I mean, you don't need, if you want to sell jackfruit, you can go sell jackfruit. If you want to sell bananas, you can go sell bananas. So why do we need DEX? When we have centralized exchange, why do we need decentralized exchange? Right? Let's just talk about it for a couple of minutes. So in most cases, the blockchain in the cryptocurrency is not controlled by a central organization. It's truly decentralized. Like apart from exceptions like TRX or Tron-based ecosystem, where Justin Sun pretty much owns most of it, right? Or there is a speculation that he owns most of it, and it's not a centralized currency. Or USDT for that matter, where it is owned by Tether, but obviously Tether is collateralized, so it's not truly centralized, I would say. But apart from those exceptions, most of it is truly decentralized, which means that it is common people who have it, who have control of it. But the irony is that we go to a centralized exchange like Coinbase or WazirX and buy it because it's so easy to do it. And it's ironical because it defeats the whole purpose of the concept that the blockchain and the crypto is truly decentralized, but the place from which we are buying it is actually centralized. And essentially what it means is that the Coinbase and WazirX and all those ecosystems, all these centralized exchange providers, they are becoming richer and richer because of the fees that they collect by selling the crypto and by buying the crypto from us. So and there are limitations to the centralized exchange, right? Like for example, many countries have got different laws, which means that you cannot trade certain popular cryptos in that currency. Like in Sri Lanka, for example, crypto, I think there is a wider ban as well. But in US, for example, right, cryptos are really harder to buy if it is a new crypto, especially. Like for example, injective protocol, we've talked about it, and I've even said that it's one of my top cryptos. And I realized that injective protocol is so difficult to buy in a centralized exchange in US. And in New York, for example, if you live in New York, then they have citywide, they have some specific rules that you're not allowed to trade, even if it is available like 100 miles across the border to another city. If you are living in New York, then you're not allowed. If you're a New York resident, then you're not allowed to trade certain crypto. So there are so many restrictions that they have in US, for example, even one of the most developed countries. And centralized exchanges control the prices using order book, spread, and fees, and they keep the profits. And especially like Geotes, in one of the episodes, we talked about Geotes, where how the order book was completely broken and why it is very important to use something like WazirX and not go with other providers, basically. And order book is very, very important. And we've spoken about how the blockchain, the underlying crypto technology is kind of unbreakable, and how much it is a technological advancement to the traditional data storage that most banks or centralized banks use. But despite the fact that we are still trusting the centralized exchanges with custody of our crypto private keys, and if the centralized exchange can get hacked, because the exchange is using a traditional security system, and the exchange, if it gets hacked, then we are still giving the keys of our crypto to those exchanges, which means that we could lose our crypto as well if we are trusting a wrong exchange, for example, which is why you need to trust some of the strongest security protocols and the most trustable crypto exchanges like Coinbase, Bitrue, WazirX, Binance, and Crypto.com. We've been talking about pretty much these 5 in most of our videos, and a lot of people keep asking about new exchanges. The reason why you don't trust the other exchanges is because the security is lacking, or the collateralization is lacking, or there's something that is wrong in those exchanges, like the order book is broken, or they're offering a higher incentive, which means that potentially they could run away with your money at any point of time, because we're talking about billions and billions of dollars here. So one of the reasons why I don't go out of these 5 ecosystems is because I've invested pretty much most of my money with these exchanges. And even with Indian exchange, I think WazirX is leap and bounds above the other crypto exchanges. And despite the fact that we are trusting our these kind of exchanges, there is still that element of risk where that the security protocol, however strong it is still a traditional security protocol. The underlying crypto is blockchain based, but the traditional security protocol that is safeguarding these exchanges is something that is used across the industry for any other website or any other exchange, I would say. And we have spoken about how sometimes these centralized exchanges, even if you have validated 100 parameters, they can have performance issues during critical time, like WazirX went down when WRX was shooting up one day. In Coinbase Pro, for example, it has had poor performance issues when you really wanted to make a good profit out of one particular crypto, and Coinbase Pro has been down, for example, right? Many crypto exchanges have gone down during critical points in time. And eventually you're putting your entire trust in one organization, and the organization's goal is to make profit. All of these centralized exchanges, the only purpose that they exist today is to make profit. So let's just boil down those things that we talked about, right, into 5 topics. Centralized exchanges, the limitations, trust, permissions, border restrictions, single institution control, and profits is all going to one organization. That's fundamentally all these problems are boiling down to. If you flip it around, the decentralized exchange is basically trustless, which means that you don't need to trust anyone. There is no need for trusting anyone because of the smart contracts and because of how they are built, and it's permissionless, which means that if I want to go and sell something, then I can go and sell it. I don't need a permission from anyone. Like in centralized exchange, if they don't allow you to sell certain cryptos, you can't sell it or you can't buy it, basically. And it's borderless and global, like I said. Decentralized exchange is like internet, right? If you have internet, you pretty much have access to the decentralized exchange. That's what the whole concept of decentralized exchange is, borderless and global. And it is controlled by the community. There is no centralized body that controls it. It is all based on a governance voting model where everybody who owns that crypto contributes to that crypto, and they contribute to the voting mechanism of it. So it's controlled by community, and profits are shared. Literally, everybody takes equal profit. The model that we've talked about, where if there are 10 people loaning out to that one guy and they all share the profits, and a very, very small percentage goes to the person who's acting as a coordinator, right? Instead of that person taking the whole cut and you get nothing, the profits are shared between everyone, and the very, very small percentage go to the validator node or go to the coordinator that is playing the role of trying to coordinate the decentralized exchange, basically. But that's the whole concept. You've basically taken all of the problems of a centralized exchange and you flipped it around in a decentralized exchange. So in summary, right, centralized exchange is like going to a supermarket or the shopping mall, where the profits are going entirely to the supermarket or the shopping mall. And in centralized exchange, you don't need to pay an entry fee, though. You only pay for what you buy. You could pretty much enter into a supermarket or a mall anywhere in the world free of cost. You don't need to pay an entry fee to go in there. But when you want to buy something, you obviously buy whatever you are choosing. But you can't sell your stuff in those shops. Like, you can't go and put a stall inside a supermarket or a mall and then start selling your stuff. You need permission to do that from that shop. But in a farmer's market, the profits are entirely going to the sellers and the farmers, and anybody can actually go in, set up a shop for a small fees. Anybody can go in and buy it, but there is a small entry fee for buyers. Typically in some farmers market there may not be an entry fee, but in most developed countries, big car boat sales or farmers market or anywhere, when you want to enter into that place and start selling or buying, for both you have a small fees that you need to pay, which eventually goes to the maintenance of that market and maintenance of that ecosystem. But anybody can go pitch up a car or pitch up a tent and start selling their products, or start selling their goods and services basically. But like for example, nobody can stop you from selling jackfruit. Like I said, if I want to sell jackfruit, I can go there and start selling jackfruit. There are no restrictions in these kind of decentralized exchange, which is like the equivalent of a farmers market that I'm talking about. So we talked about earning potential and earning opportunities in decentralized exchange and mining, right? So where does it come into picture? It comes from the liquidity provider and the liquidity mining concept. So let's look at what this means and how this translates into earning opportunities for us. Now, to understand the DEX and liquidity, there are some terminologies that we have to explain, like market maker, order book model, liquidity pools, liquidity provider tokens, AMM, which is automated market maker, impermanent laws, and how there are curve pools and balancer pools, and liquidity mining, and finally yield farming. Now, if we do the technical explanation of it, it will be really difficult. So what we're going to do is we're going to try and use some examples in a couple of minutes. And we are also going to try and break it down in layman's terminology for easy understanding of what these are without going into a technical definition of it. So in simple terms, right, in a centralized exchange like WazirX, and these pages were actually incorrectly saying decentralized in the Tamil version, but in a centralized exchange like WazirX, when you want to sell your crypto and no one's available to buy it, then you'll have a difficult time selling it. And same way, if you want to buy it and there's nobody selling it at that time, then you'll have to wait for somebody to come and sell it to you. To avoid this delay and to make this experience faster, what happens is there is a middleman that come into picture. These guys are called market makers. They always hold stock of a particular crypto, and if you want to sell it, they will buy it from you. And if you want to go buy it, they will have that stock and they will sell the crypto to you. And this process by which these guys are acting as middlemen, holding a stock of crypto always and selling it and buying it, that process is called as providing liquidity. Without these guys in place, it'll be really difficult and it'll be slow for anybody to try and sell it or buy it, because they have to wait for somebody else to come and buy it or sell it from the other side. Now, what happens is these market makers, they operate a simple concept called as an order book model, wherein they try and keep a profit margin. So if a crypto's price is saying $10 in the price charts, right, and you want to you want to buy it from them, so you go and buy it, they will sell it to you for $11. But if you want to go and sell that crypto back to them, they will buy it from you at $9. So if you actually buy the crypto this minute at the centralized exchange, you could buy it from $11, and next minute if you want to sell it, it will go down to $9, which means that you will lose out the profit. That's why you need to wait before you sell it. And generally, when the crypto is volatile, you won't notice this kind of a spread, but that's what is called as a spread between the buy price and the sell price. And that's their profit margin. They keep this $2 as a profit margin, where they will buy the crypto from you, but they will pay you $1 less, which means that they're taking the crypto from you at $9. And when you want to actually buy it and they are going to sell it to you, they will charge $1 extra to sell it to you. And by providing the liquidity, they're actually keeping $2 of every sale, or they are taking the profit of every sale. And this is called as an order book model. In this order book, the profit margin, if it's very small, if the spread is very small, that's a good order book model. Like WazirX and some of the good Indian exchanges, they have a good order book model. Binance and Coinbase and Crypto.com that we've spoken about, Bitrue that we've spoken about, we've shown in episode 15 in the demo with example how this order book is very important, and how if the spread is very small, you're not losing out on the profit that the market maker is making. But some exchanges like Geotest, where we showed in the example that market maker is making a huge profit because he is selling it to you at $14 and buying it from you at $6, where he's keeping nearly $8 of profit, which is greed out of the from the market maker's perspective, and he's making a huge profit, and we end up losing money in this model basically. Now, how the market makers manipulate these prices, sometimes in episode 7 of my share trading, I give you the link in the description. I had put a detailed chart and went through in a very simple example how these market makers sometimes they manipulate the price of a stock or a share, and how they are actually manipulating the order book as well, with a very, very simple example. That applies to all centralized exchanges, and sometimes when the price goes up and down depending upon the demand, it is because these market makers are also behind this price fluctuation sometimes, not only necessarily because there is a proper price fluctuation. Market makers can also play a big role in these centralized exchanges, and that again will result in a huge loss for us if we play into these market makers. So, but we can't take away the market makers in centralized exchanges. But in decentralized exchange, if we again bring the concept of a market maker, it defeats the whole purpose and it negates the whole concept of a decentralized exchange. And we still have the problem, then who will provide this liquidity? If I don't have a market maker, then who is actually going to buy it from me and sell it to me, and who is going to provide this liquidity? Because we need this liquidity, we need the stock in between where we are able to go and buy and sell it easily without waiting for somebody else to do it at the other end. So, which is where common people come in. All of us, any one of us, even if I have $10 worth of crypto, I can become a market maker, or I can become a liquidity provider by providing liquidity on a pair of crypto. For example, if I'm going to become a liquidity provider and I'm going to say that for Link and USDT pair, I'm going to be providing liquidity. Whatever dollar amount, whatever value I'm providing liquidity for in Link, the same dollar amount I provide liquidity for in USDT. The combined value will be like, if I'm providing $100 worth of Link, I'll provide $100 worth of USDT. So I'll be providing $200 worth of crypto as a liquidity into that liquidity pool. So what is a liquidity pool? When more and more people like us, you remember the 10 people, contributing 100 rupee each, becoming 1000 rupees. More and more people, when they contribute into that one pool, that place is called as a liquidity pool, or that concept is called as a liquidity pool. And what happens is that the first person who puts in that pair, he creates that liquidity pool, and then anybody can then join that liquidity pool, and they can contribute more and more amount into that liquidity pool. And when you provide liquidity, when you put your crypto into that liquidity pool, you become a liquidity provider against that pool. Now, what's the benefit of providing liquidity, right? So that's fine for people who want to buy and sell, because now liquidity is created. But what is the benefit that you get by providing liquidity into a liquidity pool like this? So let's take a fruit market, for example, where there is a farmer's market, for example, where people are selling different fruits, or they're giving one fruit and taking another fruit. And you intend to become the liquidity provider by providing, let's say, apples and oranges, equal dollar amounts. But before we jump into that example, let's look at a couple of more points that we are also going to cover in that example. What is a liquidity provider token? What's the incentive, right? So a liquidity provider token is the representation of the fact that you provided that $200 worth of Link and US dollar. It is basically like how if you buy a crypto, you have that crypto in your wallet. Liquidity provider token, LP token as it's called, represents the denotion that you have actually provided liquidity into a particular pool. That's proof of ownership to say that you provided liquidity. That's what a liquidity provider token is. The incentive is that for every transaction that happens, there is a fees that is taken from the transaction. So if somebody is buying or selling Link to USDT or USDT to Link for that matter, there's generally a 0.15% or 0.2% fees that is generated for every transaction. In a centralized exchange, this entire fees goes to the exchange itself, like Wazirex or Coinbase or whoever. But in a decentralized exchange, because you've contributed liquidity, depending upon what is your proportional amount on that liquidity pool, you will get that fees to your proportion. So if you contributed 20% to the liquidity pool, whatever fees get generated, if it is $1 or $2, for every transaction, you will get that 20% liquidity fees to you, and that is your benefit. That's your incentive for providing the liquidity. Now, there is a very, very big concept called as impermanent loss in liquidity mining, and impermanent loss and liquidity mining. So in the beginning, when you provide a liquidity, you're trying to make money out of the fees alone. But what happens is that it looks like a very good passive income when the crypto market is stable. But when the crypto market becomes unstable, right, you might end up with a loss. Even though you're earning every transaction, you're earning of fees, even with that, you will end up, or you might end up with a loss on one side or both sides with a number of combinations. And this loss is called as an impermanent loss if you withdraw at that point in time. And to compensate this loss, what the DEX aggregators, what the new the decentralized exchanges are doing is that they are incentivizing you more by providing a reward on top of the fee structure, on top of this process of collecting fees, and that reward is called as liquidity mining. And we will see that with an example of the orange and apple like I talked about. So let's take a farmer's market where people are exchanging apples and oranges, and you intend to become a liquidity provider in this market. So which means that you have to supply both apples and oranges in equal value, not the quantity, but the dollar amount that we spoke of. So let's say one apple is 4 rupees and one orange is, let's say, 1 rupees, and you want to provide 400 rupees worth of apple or oranges. So you have to provide equal value, equal dollar amount, right? So you provide 100 apples, which are 400 rupees, and 400 oranges, which are again 400 rupees. So in total, the value you're providing is 800 rupees that you're providing liquidity into it. So the first person who comes, if they are buying oranges from you and giving you apples, so they will give you 10 apples, and let's say they will take 40 oranges from you, because that's the equivalent amount that you need to give them. So now you have 110 apples in the first trade, and you have less oranges. They've taken away 40 oranges from you, so you have 360 oranges. And let's assume the fees paid in every transaction is 5 rupees to you. That's your proportion. So keep it as flat for this example, right? What happens at that point is that, let's say the prices are remaining same in this scenario throughout the end-to-end process, which means that even at that point your value is still 800 rupees. Total value of your apples and oranges put together is 800 rupees. Now the next person comes in, or the next few people who come in, they're all buying apples and giving you more and more oranges. So which means the stock of your apples will keep going down. So first person buys 5 apples, gives you more oranges, 20 oranges, and they keep buying apples from you, and they're giving you more and more oranges. And eventually, when the last trade is completed, they've bought more apples from you, and they've given you more oranges. So which means that you've got now 50 apples in hand, and they've given you more oranges. So you have 600 oranges in hand. If you keep the price of the apples and oranges as the same, then you still ending up with 800 rupees in total worth of apples and oranges. And if you had not participated in the liquidity pool, then it would have still been, if you had kept your 100 apples and 400 oranges, it would have still been 800 rupees. There's no difference. But the 5 trades that happened, each of them giving you 5 rupees, you've now gained 25 rupees in terms of the liquidity provider fees, which is your gain. That's the passive income that you have generated by keeping your apples and oranges. But obviously your quantity has now changed. Now this is true if the prices are remaining the same. What if the prices are not remaining the same, right? So in the same example, let's take the scenario where your cost of the apple is going up and the cost of the orange is remaining the same. So for example, your cost of the apple is going up from 4 rupees to 6 rupees after those trades have all completed. Now, had you not done this liquidity provider concept, have you not provided liquidity, you would have had 100 apples and you would have had 400 oranges, which means a combined total of 1000 rupees. Now, because you participated in the liquidity provider pool and you become a liquidity provider, you have only 50 apples, which means that in total you have only 900 rupees, despite the fact that the quantity of oranges have gone up, the price of the orange is still remaining the same. So which means that even if you add the 25 rupees fees or commission that you got on top of the money that you will have after the end of the liquidity provider pool, you will only end up with 925 rupees. Had you not participated, you would have had 1000 rupees. That 75 rupees difference is your impermanent loss. I didn't even go into this liquidity provider concept, and I could have actually made, because my value of the crypto that I have quantity less is now gone up. I am not going to be able to make the same amount of profit that I would have made. That's your impermanent loss, because if you had not done this, you would have made more profits because you have done liquidity provider concept. Despite the earning that you got, you have now less total value than what you would have had if you had not done it. That's your impermanent loss. Now, this is a scenario where the value is going down by only a small amount. Now, imagine that both sides it's happening, that your crypto that you have lesser, the value has gone up. The crypto that you have higher, the value is going down. Orange is going down. So for example, the Apple value is now going up to 6 rupees. The orange value is now going down to 80 paisa, right? So it has also gone down. So which means that because you've got more oranges, your value will be totally even lesser. So you now have only 780 rupees. Add up the 24 rupees, you have only 805 rupees. Had you not done the liquidity, had you not participated in it, your total would have been 920 rupees. So your impermanent loss is now even higher, to about 115 rupees. So till now we saw only the profits that you could lose because you are not holding on to the crypto. But still, the value that you had was 800 rupees. Now you have 805 rupees. Now, but there could be a scenario where you might end up losing that value, even if you had participated in that, despite that money that you earned from the liquidity provider fees. That is, if the crypto that you have, or if the oranges that you have more in your hand, if it goes down by, let's say, 75p, right, instead of 80 pence, then the total value that you will have after the participation will be like 775 rupees, which is even less than the money that you had originally. So even if the prices had not even gone up, you could have ended up with a loss scenario. That's what we are talking about here, where despite the fact that you had 800 rupees and now you have less amount, even though you have participated in the liquidity, you become a liquidity provider, you got the fees, you earned that fees, still your total value is now less, you ended up making a loss. Now, why would someone then participate in liquidity provider fees? Why would someone take this risk? Because DeFi mining is coming with this inherent risk, and this is very, very important to understand the concept of impermanent loss, because this is a very, very valid risk scenario. How do I avoid this? How do I incentivize people then to take a risk in that particular scenario, where it is a very common scenario? There's a number of permutation combinations. We can go on and on basically. But how do I incentivize people, right? So I incentivize people by giving them a liquidity reward. Now take the same scenario where I ended up with a lesser amount in hand, and now I'm putting on top of the fees that you will gain normally for every transaction, I'm giving you something called as a liquidity reward in addition to that fees that you are earning. That liquidity reward, let's say it's about 130 rupees, right? That liquidity reward will now mean that, okay, you will have more than 905 rupees in total when you participated at the end of the liquidity, when the liquidity ends. So net gain is still 5 rupees. So had you not participated, you would have got 900 rupees. Because you participated and you got that liquidity reward as well on top of your normal fee structure, now your total gain is about 5 rupees. So that's that liquidity reward mechanism, and going after a liquidity pool that gives you a liquidity reward is called as liquidity mining. And that's where you can make money out of it, despite the fact that there is a risk about impermanent loss. Over and above your impermanent loss, you are looking at the liquidity reward and saying that will be covering my risk scenario in terms of the impermanent loss. So, so in summary, right, you could always end up losing lesser value in terms of quantity on either side of the pair. You will definitely, for the very first time a trade happens, one of your pairs is going to become less and one of your pair is going to become higher. And there's a number of permutation combinations where both sides could become lower, both sides could become higher. And if you look at the examples, you will realize, if you play around with apples and oranges, you will realize how that's possible. I'm not going to go into that level of permutations and combinations. But the liquidity reward needs to be good enough that you can make a decent profit out of it. These days, a lot of liquidity mining rewards can go up from 100% APY to about 500% APY in some of the pools. So the option is to look for a reward mechanism where the APY is at least decent enough that you think that the liquidity mining reward will cover your liquidity risk scenario of impermanent loss. Liquidity mining as a concept is still fairly new to people, and then that's one of the reasons why a lot of people have not indulged in it. But still, there's a whole lot of community that is built around this liquidity mining. There's a lot of players that have already come into the market. But the process is sometimes very cumbersome and needs a little bit of learning of all these fundamentals. and the risks are extremely higher if you do it incorrectly. If you don't understand it, and if you try and do it, you might end up you end up with a loss, like I explained, right? So a lot of centralized exchanges, they take crypto from the holders. They tell them that they're going to safely invest it in DeFi mining on their behalf, but they'll give a far lesser reward because they're using our crypto to earn from the DeFi earning opportunities, and they're giving you a very, very less return in terms of the safety that they offer. For example, Bitrue had offered 145% liquidity mining APY reward if you participated in the liquidity mining yourself for the BTR USDT pool. But if you did it yours, if they did it for you on your behalf, they were offering a 30% APY return, and you can actually go and see the notification in which they posted this, where they give you both the options. If we do it, we'll give you 30%. If you go and do it yourself, in a decentralized exchange, you can get up to 145%, but the risk is yours. So that's what centralized exchanges these times are doing. They're making it easier for players who don't understand what DeFi mining is, and they give far lesser rewards. But if you understand it, you can directly go after the higher reward mechanism. So how do you do it? Where do you do it? So all this theory is fine. Now where do we get in? How do we get into the practicals, right? So in the initial days, the decentralized exchange, the whole concept of DEX was made popular by Uniswap almost single-handedly, I would say. And then it still continues to be the dominant DEX provider or dominant DEX enabler, I would say. And most of the popular Ethereum-based decentralized exchanges are Uniswap, 1inch Exchange, Balancer, Banker, Curvepool. Balancer, Banker, Curvepool, they are interesting because they brought mathematical formulas into picture to minimize this impermanent loss or to tackle the price variations, and they had really interesting calculations that they brought into perspective. There's absolutely the Curvepool, for example, they were trying to make sure that the price fluctuation do not cause too much of an impermanent loss to the liquidity providers. But it's fascinating to read all of it, but it's far too technical for this particular topic today. So we're not going to go into the details about balancer pools or curve pools in detail, but those are all exchanges that were built upon mathematical models and mathematical principles. Loop ring as a concept, we've talked about loop ring in our previous episodes as well. They are doing something called as a layer 2 of Ethereum, which is scalability. Ethereum has got fundamentally big problems like scalability and fees. Loop ring is trying to do a solution to that scalability problem, and we'll see a demo of loop ring as well in the end of this video. So Uniswap, like I said, right, this still continues to be the most popular crypto exchange. And when there is a crypto that is very, very hard to get from any exchange, or it is hard to get from a centralized exchange, Uniswap, like injector protocol, if you're in US, you can easily get it from Uniswap, for example. So, but for a long time, Ethereum was the only blockchain, most of the decentralized exchanges were using only Ethereum to execute these smart contracts. Because Ethereum was predominantly, I think in 2015, they were the first blockchain to introduce the concept of virtual machines which can execute the smart contracts inside a blockchain or alongside a blockchain. So they enabled this, in fact, technically. So even today, predominantly most of the decentralized exchanges are using Ethereum. But the biggest problem with the decentralized exchanges today and smart contracts today is the Ethereum scalability and gas fees. Ethereum processing is extremely slow. It is like running a 2021 3D game on a 2010 computer. It is that slow, and then the fees is exorbitantly high. I mean, imagine the internet fees that we were paying 10 years back compared to the fees that we're paying today, right? So the fees is extremely higher, and the scalability is also part of the problem, actually. And it is what it means is that the cost of executing these transactions is insanely higher. I'll show you with a demo of how high this fees is and how it kills the whole concept of decentralized exchange for small players like us. Only people with a large amount of money are now able to make decent profits out of it. So if you use Uniswap to swap two cryptos as a small investors that you couldn't buy anywhere, for example, you will end up paying for like £100 worth of crypto. If you want to buy, you could end up paying up to £200 in gas fees and fees alone if the network is congested, which means that I'm only buying $100 worth of crypto, but I actually have to spend $300 because $200 is the fees for buying that crypto because the network is congested and you need to pay for it. And sometimes if it is over congested, then you're actually paying extra to speed up the process. So imagine a toll road, right, where you're carrying a package from one city to another city, and they are giving you a benefit to say that you take it from one place to another place, you'll get 200 rupees for the package for doing the job. But then you take a taxi to do that, and then the tolls are charging you almost like 600 rupees, and then there is the taxi is charging you a surcharge because there is a peak hour traffic. So eventually what will happen is you will end up losing more money than the money that you are gaining out of transporting the package. Same goes for liquidity mining as well. Doing it on a Ethereum based network, you will end up paying so much in fees that either as a trader or as a liquidity provider, you will end up making huge losses because of the Ethereum gas fees. So like I said, there are some projects like Curpool, Banker, they're trying to solve the impermanent loss problems, but they're still struggling with the scalability in gas fees. Loopring, for example, has solved this scalability in gas fees to a large extent. What it has done is that instead of going in an auto or a taxi, you're going in a share auto where 10 people can get into the auto and they're going in the same road. So you are only paying like 5 rupees or 10 rupees instead of the 100 rupees or 200 rupees that you need to go. So that's the whole concept of loopring. It's basically just taken a single person taxi or a single person auto into share auto where they can go together. And I'll show you a demo of loopring as well. But still, there are some problems with this loopring because it is not going from the correct destination to the correct destination all the time. So the share auto runs only in a specific route, for example, right? So let's go into a quick demo and then we will see how we can use these decentralized exchanges and how we can connect our wallet to these exchanges and how we can do the liquidity mining or the liquidity provider or DeFi swap, for example. So we have to understand three things before we go into the demo. One is the DeFi wallet itself. So we saw in episode 23 what is a decentralized wallet, right? DeFi wallet is basically a non-custodial wallet where you are not giving custody of your private keys to an exchange like WazirX or Coinbase. You hold the wallet on your mobile phone or on your device, and nobody knows that wallet other than you because you're holding the entire wallet on your mobile phone. And it takes literally 2 minutes to create a decentralized wallet. And we saw it in episode 23, how to create it in the crypto.com DeFi wallet when we were staking it in the crypto.com DeFi wallet. Today in the demo, we'll be creating a Coinbase DeFi wallet. I'll just use another example and I'll show you how to create a Coinbase DeFi wallet in your mobile phone. And you use a mobile phone DeFi wallet. To trade on the computer, you need to connect it to that exchange. So there will be decentralized exchanges, and we have to take that mobile wallet and we have to connect it to that exchange on the computer. So we have some standard options to connect the mobile wallet to the exchange. And today we are going to be so there's a very, very common wallet connection option called as Wallet Connect. But today we'll be using the Coinbase wallet connection itself, which is native to Coinbase wallet. And if you want to do decentralized finance without a mobile phone, because the DeFi wallet that we are talking about is created on a mobile phone, you can do it still in a computer alone, but that can be done using a concept called MetaMask, which we'll cover as a demo separately in another video. So let's go into the demo right now. So we're going to create a Coinbase DeFi wallet. So you can search for Coinbase wallet. That's not the Coinbase app that we had previously seen in episode 3. That will be a Coinbase DeFi wallet. It will just have Coinbase wallet in their name. I think it's from Toshi on Apple and don't know what it is called in Android. But you can see it's called as Coinbase wallet. So you're going to create a new wallet and you accept the terms and service, and you need to give a username here. This is an additional functionality where if you want to send from one Coinbase wallet to another, you can use this name to send it. I recommend keeping your wallet name as private so that others cannot search your name, because again, if you don't really intend to keep transferring, you can use that. I use my Touch ID. If you don't have Touch ID, you don't need to enable Touch ID. You can just go with the normal wallet creation itself. Once the wallet is created, it will ask you to back up your wallet. The backup option is again a 12 word phrase, which we saw in the episode 23. If you want to see it, you can go back to episode 23 and see it, and you have to note it down at that point. Now my wallet is empty. I have no money in the wallet. Now I'm going to click on receive, and I find my address, and like a normal crypto transfer, you can transfer from one exchange to another exchange. You can use this address to transfer. What we're going to do is we're going to connect to the Coinbase account, which is the benefit of this DeFi wallet, and transfer it a lot more easier. So I click on settings, connect to my Coinbase, and click on the connect to Coinbase account, and it will open up the Coinbase account in my phone if I have the Coinbase app in the same phone, and it will instantly get connected. Now we go to the same crypto and click on the 3 buttons. Now you have the option of transfer from Coinbase. So I click on the transfer from Coinbase, and I open my mobile phone as well. But in that Coinbase wallet, now it is showing my the Coinbase balances. Whatever balances I have in my Coinbase normal account, it is showing it. I'm selecting my Ethereum. First crypto that you need to transfer is always Ethereum, because you need Ethereum to do all the transactions. So I'm sending literally, let's say $200 worth of $218 worth of crypto, and it is saying the miner fees is $6. The mining fees is $6. Relatively, sending Ethereum from Coinbase to Coinbase wallet is cheaper. That's why we are using this option today. So I put my verification code that I get in my authentication app for Coinbase, and I'm inside the DeFi wallet itself. I'm not switching to my Coinbase. My transfer has been initiated. So now my my Ethereum has come from my Coinbase account to my Coinbase DeFi wallet. The same way, I can bring in any currency. Now I bought US dollar as well in the same option. Now I click on US dollar. I have this option called as earn interest or convert USDC. So I'm going to use convert USDC for the first option. So I'm going to flip from USDC to another currency. So let's say I'm trying to convert $20 of USDC to Ethereum. So I'm looking at what is the conversion fees. So it is using an inbuilt conversion. It is showing that you need at least $140 worth of Ethereum fees to convert $20. So if I want to buy $20 worth of crypto, it is asking me to spend $140 in fees. That's what I was talking about. I wasn't exaggerating at that point of time. And then there is an option of earn interest. This is the DeFi loan or the DeFi lending concept I spoke about. Decent interest rates here, 10%, 6%, and 9%, and so on, 5.9%, and so on. So if I select, let's say Compound is one of the famous DeFi lending providers. If I select a Compound and say that I have $20 and I want to lend this $20 and I earn interest out of it, or $130, I want to earn interest out of it. It's saying $71 in terms of the fees if you want to earn 6% or 7% interest out of your $130. It doesn't even cover the total interest that I'll get in an entire year. So if I choose a higher interest rate, for example, like 9% with AAVE, then again the fees is even higher at this point. Like if I select that and continue, I'm not completing this transaction, I'm just showing you the fees. $123 worth of fees for trying to earn interest, 9% interest out of a $130 transaction. So it's absolutely not worth it. Now I'm going to try and do it in the Decentralized Exchange using Uniswap, connecting to the Uniswap. Now on the computer, I've gone to app.uniswap.org and I'm going to click on this connect to wallet. If I click on connect to wallet, you will see these options. So MetaMask, I told you we'll see it in a separate video. That is if you don't have a mobile wallet. Wallet Connect is the most common interoperable, like your USB cable that you connect to your phone, right? Most Android phones come with Wallet Connect. Coinbase Wallet, like an Apple iPhone Lightning adapter, specific to Coinbase. So we're going to use, we're going to open my phone. On the left side, I'm going to open the Coinbase DeFi wallet. And in the DeFi wallet, when I click on the connect to wallet and use Coinbase wallet, it will give me a QR code. And in the settings option of my DeFi wallet, there will be an option called wallet link. So you click on the wallet link, it will open the QR code scanner, scan this QR code, and in your Coinbase DeFi wallet, it will now get connected to this Uniswap, and it will show you wallet link as 1, and it will show you that it is now connected to Uniswap successfully. And you can disconnect it at any point from your mobile phone itself. Now, if I go to my Uniswap exchange on the computer, you can notice that it is showing my USDC and my Ethereum that I have on my DeFi wallet on the left on my mobile phone. Now, on the Uniswap, again, now I can take my currencies and I can spend my currencies, but every time it will ask for an approval. Now notice that I have injective protocol added on the DeFi exchange. So if I'm in US, for example, I can do this easily. But If I try to buy injective protocol for $130, let's see what happens. So I put $100 for example first, and I can see the exchange rate and everything, $13 per injective. The rates are all correct. The rates are all from the liquidity providers, so it is all correct. So if I click on let's say the conversion, you see that the liquidity provider fees is there. That 59 cents is going to go to the provider who is actually providing this liquidity behind the scenes, like you and me basically. So if I say $130 worth of US dollar, I want to buy injective protocol, and I click on approve, you notice there is an approve payment. After the approve payment is costing $17. This is just to approve our spend of Ethereum our spend of USDC and Ethereum in that Uniswap. So we are not actually transacting here. We're just approving our transaction. That itself is costing $13. So roughly you are paying like, $15, $20 just for approving Uniswap to access your money and spend it. Now, after you clicked on approve on your mobile phone on the DeFi wallet, you notice the approved is enabled and swap is there. So click on swap and there is a confirm swap option. So there is again a liquidity provider fees now, which is higher. Now you notice that the second request has come through for the actual swap, and you see the fees is now $78. So to buy $130 worth of injective protocol, I am asked to pay $78, almost $80 in fees. So that's the disadvantage of Ethereum. I am not proceeding at this point. I'm not going to spend I'm not going to spend $80 to buy $130 worth of injective protocol. So if I'm buying $1,000, $2,000 protocol, this $78, $80, $90 worth of fees is justified, but for small amount, this is not justified at this point. So how do I become a liquidity provider, right? That liquidity fees that we saw, 50 pence, 60 pence that we saw. How do I become a liquidity provider? So click on the liquidity pool or the pool option on the Uniswap page from the swap page, and you can click on that, read more about liquidity pools. So they will have the same explanation that we talked about in our video, and actually if you go into the video, they have a lot of documentation, but it is all mathematical formulas in terms of how the calculation is done. In fact, understanding returns, this is an excellent article about what is liquidity and what is impermanent loss and how the calculation is done. But if you actually go and read it, that's when you'll understand how technically complex these articles are to understand sometimes, and sometimes it is easier to break it down if you give a different example, which is what we have attempted in this video. Okay, now I want to become a liquidity provider. I click on add liquidity. So when I click on add liquidity, it will ask me to create a pair. So I'm saying Ethereum on one side, I'm saying USDC on another side. So if I'm trying to give $109 worth of USDC, it is asking me to provide an equivalent amount of Ethereum. So if I click on supply, again, it will open my crypto DeFi wallet, and you can see that I will earn 0.3% on all the trades that are going to happen. So I click on supply, and there is a confirm supply option. So once I click on the confirm supply, my DeFi wallet is going to open up and going to show me the fees for participating or becoming a liquidity provider. Now it is saying $110, or for doing $110 worth of transaction, it is asking me a minor fees of $43, which is extremely high, and I may not even end up getting the liquidity fees out of this liquidity provider pool by paying $43. So I won't even make up the fees that I'm going to provide, so I'm not going to do it. But if you click on the charts, for example, on the Uniswap arc, you can see what are the liquidity pairs that are currently existing in Uniswap. And you can, if you click on the pairs option, which is very important, you can see almost nearly $8 billion of liquidity is being provided. So you can see the liquidity percentage. The last column is very important, which is showing you the percentage APY that you can gain by a 24-hour volume that they're showing. So that's how much people are earning money for providing liquidity for that particular pair. There are some cryptos like Tribe, for example, the new crypto and relatively harder to get. And if you have it and you provide liquidity to that pool, then they're saying that you could earn up to 500% APY. That is again a yearly interest that they're showing there. If you earn it for 1 day, then you have to divide it by 365. That's your interest. So your interest will be far, far lesser if you're providing it for only 1 day. It's not that you will get 500% return. It is only if that continues in the same proportion for 5 years, for 1 year, you'll get 500% return. But that gives you some indication in terms of how much you can earn by doing the swap. And if you click on the swaps, actually each swap will have a fees against it. So everything is visible, nothing is invisible, right? Every swap is visible, and you can see the fees against every transaction, and you're getting that fees, that's 0.3% fees that you're getting for every transaction, proportionate to the investment that you're making into that liquidity pool. So that is how you will earn for the liquidity. So we saw Uniswap, which is the normal Ethereum based decentralized exchange, and we were saying that we'll also take a look at Loopring, which is the scaling engine or the L2 layer of Ethereum, and how it is improving the gas fees, and how it is improving the Ethereum fee structure and the scalability problems, but also the problems comes with it. So in Loopring, what they've created is an L2 wallet or an L2 level exchange where the costs are much lesser. But to create a new Loopring wallet today on the L2 wallet, it costs about $200. That's like an entry fees for you. And then every time you want to move Ethereum from the L1 to the L2 layer, it costs about $150 to $200. But once you're inside the L2 operating ecosystem, then all your DeFi swaps and all your liquidity is provided at low cost, and it is faster. But if you're moving less than $1,000, for example, you're almost spending like $200 to $300, $400 in fees for creating the wallet, and then this one-time entry into the L2, and which means that you will not make profit. But if for example, I moved like $1,000 worth of Ethereum into Loopring about 3 months back, and now it's approximately $2,000 because of the liquidity fees and because of the liquidity mining that I've done over the past 3 months. So it's not for small investors clearly, but let's see a quick demo of how you can use it. So in this example, I'm going to use mobile wallet, the Loopring mobile wallet. So you can go to loopring.io, and you can click on the link for either the Google app or the Android app or the iPhone app. I have not used an iPhone app yet. I'll show the demo, but so far I'm effectively using only the Android app because that was the one that has been existing for the last few months. So if you go to the App Store, and if you click on the link, it will open up the App Store, and you can install the Loopring wallet like a normal DeFi wallet like we've done in the previous scenarios. And you can also click on Create Wallet. It is going to create a DeFi wallet on your mobile phone. So unlike the other DeFi wallets which use the 12-word phrase, they'll use a mobile phone verification. And here you can use my referral code if you want to do it, but I suggest if you're not a large investor, don't do this for now. So here is where the catch is, where they'll give you a wallet address and say that to activate this wallet, to enable this wallet, you have to spend $200 worth of creation fees, which means that you need to send Ethereum to that address, and then you can claim that address for yourself. That address then becomes your wallet address. That wallet becomes active at that point of time. Now I'm not going to do it. I'm not creating a new wallet. I'm using my existing wallet to proceed with the rest of the demo. So it has an L1 and an L2. What is L1 and L2? L1 is the normal Ethereum, you can see there, and L2 is the Loopring layer or the scalable layer that they've created. So if I have to send a crypto to the L2, I can't send directly. I have to send it to L1, and then from L1 I have to transfer it to L2. So now I have sent it to my L1 like a normal crypto to crypto transfer. I've sent it to my L1 exchange. But when I want to move it from my L1 into my L2, for example, I have $200 worth of Ethereum, and if I want to move it into my Loopring layer 2, where I can start becoming the liquidity provider, you notice that it is almost asking for about $200 worth of fees. So to move $200 worth of Ethereum from L1 to L2, it is asking so much fees. So it's negating the whole concept. But once I move into L2, once I'm in that ecosystem, then there is hardly any fees. Like for example, if I want to swap Ethereum to DYOR, which was a coin that was trying to provide liquidity, and I click on the swap option, you will notice that there's hardly any fees there, because now we are in the layer 2 ecosystem, and the layer 2 ecosystem, the swap is completely done without any gas fees practically. And again, providing liquidity is also similar. You're not having to spend like $50, $60 worth of gas fees like in Ethereum, like in the normal ecosystem like Uniswap. So here, for example, I'm trying to become a liquidity provider of the same swap I did. So I'm providing 3000 DYOR coin, which has an equivalent dollar amount of 0.3, and I click on yes, and you can see that the fees it's literally free to provide liquidity. To withdraw it, it is a very, very small fees of about $15-20. And you can see at various points in JRT, for example, at various points, it keeps increasing, and you can see the mining rewards at the bottom. That reward is what we talked about in an Excel, right? And that's the reward that we are getting. So apart from the fee reward, which is our fees that we get from every swap, the mining rewards is what makes it more profitable, right? So now we've spoken about Ethereum and about the whole benefits of doing it, but the fees is obviously a big blocker. So how do we actually do it? How do we get onto it? So there are a lot of alternative blockchains that have enabled smart contracts on their blockchain. They're attempting to provide an alternative to the Ethereum ecosystem. Tron tried doing this with TRC20, but the problem with Tron is obviously that it's not truly decentralized. And so there's a lot of DeFi that is logged into Tron ecosystem, but it's still not as popular as the Ethereum ecosystem. But it was not until recently that when Binance actually changed their blockchain, they used to have a Binance chain, which is BEP2, which didn't have Ethereum, which didn't have the virtual machine or the smart chain concept. And recently, I think about 5-6 months back, when they enabled the Binance Smart Chain, BSC, and they changed their token system, or they brought in the additional token system of BEP20, that the DeFi became extremely affordable to small investors. And again, offering similar incentives like the Uniswap or the loopring 500%, 300% APY profits for small investors with literally negligible fees. So the Binance Smart Chain, using BEP20 tokens to do the liquidity mining and yield farming, it needs a dedicated episode on its own. And my next episode, I'll be doing a full detailed demo of the Binance Smart Chain using some of the popular yield farming exchanges like Uniswap. I'll be showing you a demo of how to do it for the BEP20, how to use Binance Smart Chain. So again, using ultra low fees, and how to do the DeFi earning, how to become a liquidity provider. We'll be going through a detailed demo. Now that we've covered all the basics, we'll get straight into the Binance Smart Chain demo in the next video. And it wouldn't take this much time, because now we've covered all the basics, and this is something that you needed to know before you get onto that and do it properly with a full understanding of how to do it properly. So hopefully this was useful. Like I said, a lot of effort had gone into preparing it to make it easier to understand for people. So hopefully you understood it if you spent enough time about it. And until next time, thank you, bye.